Hello, this is Elizabeth Pluswick, and today we're going to look at a variable costing income statement that I've prepared to do what-if analysis. This is a planned income statement to plan production, costs, and profits at, in this case, a 1,000 unit level of production per month. So I've created an Excel spreadsheet, and you can see here that it looks like an income statement over here with sales revenue, variable costs, and fixed costs down here, and I have a column for total and then a column for per unit. And in this case I have chosen 1,000 units of production. So for instance, sales revenue is $800 per unit times 1,000 units produced and sold, and so we can see here that sales revenue for the month then is projected to be $800,000. Now, a few interesting things about this kind of income statement, which is good for internal planning and decision making, is that the variable costs are all listed first, and you'll notice that there's a little subtotal here called total variable production cost. So those include, production costs include direct material, direct labor, and variable overhead that happens in the factory. We get a subtotal there, and that is the cost of production to produce those 1,000 units. Separately from that, we have variable selling, general, and administrative costs. Because remember, in a variable costing income statement, all of the variable costs need to be grouped together and then subtracted from sales revenue in order to get contribution margin. So again, contribution margin is sales revenue minus all the variable costs equals contribution margin. Sometimes you want separately just the cost of production, and that's why the subtotal is here too. Selling and administrative costs are not production costs, so they're listed on their own line right here. So for all of these, first part of the income statement, sales revenue, variable costs, and contribution margin, we have it in total and then also over here on a per unit basis. You'll see here that contribution margin is $190 per unit, and we could also then at this point compute contribution margin ratio, which is needed in calculations for break-even point in sales dollars. So contribution margin ratio, if you recall, is contribution margin per unit divided by selling price per unit, in this case $800. So you can compute that contribution margin ratio and use it in break-even analysis when you want the answer to be in sales dollars required. Okay, so going back over here then to this part of the income statement, from contribution margin in total, then we subtract all the fixed costs. So we have total fixed costs here. Some generally commonly used fixed costs are listed. Subtract that from contribution margin to get to income before interest and tax. EBIT is often how you'll see that, or IBIT. Interest on debt is then subtracted to get income before tax. And in this case, I've assumed that corporate income tax for both federal and state income tax is at a rate of 30%. So the income tax in dollars is 30% rate times the income before income tax. So I've programmed this into my Excel spreadsheet where I take this cell times this cell equals the amount of income tax on that income. That way, if I change any of the sales revenues, costs, or production levels, I'll get a new number here calculated automatically, and I can also vary the income tax rate I put in this cell, and all this will calculate automatically because I've programmed the cells to do that in Excel. So subtract income tax, and we're down left with bottom line net income, and of course you could compute that as a percent of sales. And that's also a commonly used number too to gauge performance from one period of time to the next, is rate of return on sales would be net income divided by sales for that same time period. So there's the variable costing income statement in total and per unit, and with a little bit of explanation of the usefulness of this kind of income statement to do planning for profits.